there's a week to go reporting season. It's been a huge season so far, and there's a lot to come still, but a lot of information for us to sink our teeth into. But I just wanted to step you through some of the scorecard and talk to some of the themes that we see unfolding through reporting season so far. So as of today, we've seen about 40% only of the ASX 300 report, but within that, almost 70% of the top 50. So we have got a really good picture on the outlook for the most important companies in the market. As a generalisation, you can see on the left there that the beats have far exceeded the misses, again, as we thought that they would, but probably not by as much as they did last season. And I think if you can have a look at the data, you can see that the beats are really dominated by small caps this time, whereas the large caps are sort of in line with their longer term average. And you'll probably see that outperformance or the beat rate sort of dwindle or deteriorate as the poorer quality results generally occur late in the season. But I do think we'll end up having a season similar to what we saw in August last year, where we saw across the board generally surprising expectations versus normal. The price action has been pretty sensible. The beats have been outperforming the misses by about 10%. And on the right-hand side there, it's been quite pleasing to see that the flagged positive reactions have been doing what the analyst team said they would. So the flagged beats are up 4% versus the market 2% since the publication of our preview back in July. So generally speaking, market's been doing what we thought it would in terms of results. Just looking at revisions in Outlook, on the left-hand side there, you can see the trajectory of annual earnings expectations through time. And what we have noticed is that there's been a tapering off of an improvement in the FY22 number. So far, we've only seen a 0.5% upgrade to profit expectations into 22. That number is going to move as we see more companies report, and it does take time for some of these revisions to flow through into consensus numbers as well. But generally speaking, I mean, recall that we did see some huge moves through June, July. I think there's 5 to 6% EPS upgrades for next year occurring in the last sort of 8 weeks. So we did reset to a pretty solid base, but I would comment that I do think the outlook for earnings and dividends is pretty conservative into next year. And that's probably only a function of the fact that guidance so far has been pretty limited. I think only about a quarter of the ASX 100 have actually issued any guidance. And in most cases, it's been cautious or flat or even negative in cases. So I do think, the risks around earnings upside are probably ratcheting higher, but they're certainly not in the market's numbers at the moment, particularly for dividends. The market's actually forecasting dividends to contract next year. A lot of that will be resources driven, but I would say that there's quite a few conservative outlooks there for dividends. And dividends really has been a surprise for this season. It's one of the themes we called out pretty strongly. And across the board, I think we've seen quite some solid surprise dividends announced. We're not talking, if you exclude the iron ore producers, they're not huge beats, but they're pretty solid across the board. And if you look at the run rate of companies upgrading or even paying higher dividends through the cycle, we're rebounding quite strongly there. So the number of companies upgrading or paying higher dividends period on period is approaching or recovering back towards pre-COVID levels. Indeed, about 40% of the established dividend payers in the industrials segment are paying higher dividends now than they were pre-COVID. So you can see that the top end of the market has been quite prudent at managing their capital and has been quite resilient in terms of earnings and dividends through this period. And there's been probably a dozen companies that have resumed dividends this period. And as I said, the outlook or the expectations for divs going forward are quite conservative across the market. So at least, expectations aren't getting ahead of themselves as we reflect some of this cautious outlook commentary. Just on the right-hand side there, the key earnings or recommendations upgrades for both us and the market. Still a lot to occur here, but a trend you want to call out is probably the resources segment. It's been slammed actually through August so far. So resources down 13% versus industrials up 4.5% to 5% August to date. So it's not surprising that the better opportunities so far have been emerging through some of those mid-cap resources named. South32 Oz Minerals have been in our model portfolios on several occasions, starting to look really interesting. We've got small and mid-cap names in there, including Redbubble, Beacon, reporting solid results with analysts upgrading to buy here and there. So I do flag that we're going to see quite a few more ideas flow through in the next week or so, particularly if we do get some of this anxiety flow through into weaker pricing.